It is absolutely possible to get very rich from stocks if you follow a few pretty simple principles. That's what we're going to talk about in this video. This is no BS advice to get rich from stock market investing. If you're new to the channel, welcome. I'm Austin. I'm a co-owner of cloudmusicsuite.com. And most importantly for this video, I'm a stock market investor, okay? We're glad to have you here. Let's jump right into the video. First thing, if you haven't started your stock market investing journey, start right now. There's an extremely high correlation between being in the market for many years and having a ton of money in the market. The stock market investing game is one where you benefit greatly from having time on your side. The sooner you're investing, the sooner you can start to grow your money. So if you haven't started investing yet, once you're finished watching this video, go ahead and open a brokerage account with one of the big firms like Fidelity, Charles Schwab, JP Morgan Chase, etc. But I would bet that most people watching this video have already started their stock market investing journey. So let's get a little deeper. The best and most successful stock market investors are very, very long-term focused. They're okay if it takes 5 years, 10 years, 15 years, or 20 years to reach their goals with stock market investing. The great Tony Robbins likes to say, we vastly overestimate what we can achieve in 1 to 2 years, and we vastly underestimate what we can achieve in 1 to 2 decades. It's absolutely possible by the end of this decade, starting from right now, 10 years from now, you can add a zero to your net worth. And what I mean by that is if you're at $100,000 net worth right now, over the next 10 years, you could very realistically be at a $1 million net worth, and stocks could be the primary driver of that. And the main reason for that is that compounding effect. The more money you build up in your accounts over time, the more that money starts to work for you. Let me give you a specific example. If you have $10,000 in your stock market accounts and you get a very respectable gain of 20% in 1 year, then that means you'll have made a profit of $2,000 in a 1 year span, which is respectable if you're just starting out. But let's bump that up to $100,000. If you have $100,000 in your accounts and you get that same 20% return, you will get a $20,000 gain. Now that's getting more exciting. Now bump it up one more time. Let's add a zero. If I have $1 million in my stock market account and I get a 20% gain, that's $200,000 in a 1 year span just from the gains alone. And just to put that in perspective, when people are starting out, it can take them multiple years to get to $200,000, maybe 4 or 5 years to get your first $200,000 in the stock market, depending on your income and how much you have to invest, of course. But it normally takes people quite a while to get to a milestone like $200,000 in their accounts. But then fast forward a few years, you're up to $1 million, and it only takes you 1 year in just the gains alone to get another $200,000. And then the next year, if you're able to get a 20% return again, now you're getting a 20% return on that $1.2 million, which is a gain of $240,000. The numbers can get absolutely ridiculous very fast, and the gains start to take over once you've got a lot of money in your accounts, but it takes years in order to get to that point. It's not a month's game. It's not, okay, over the next 5 to 6 months, what do I want my portfolio to look like? No, over the next 5 to 6 years, or over the next 5 to 10 years, what do I want my portfolio to look like? That is the type of time frame that's going to lead to major success in the stock market over time. All right, now next up, you really need to commit yourself to this. Every single pay period, you need to be putting money into your stock market accounts. And in my opinion, the minimum amount of money that you need to be investing on a monthly basis in order to really get your accounts to start growing substantially is $1,000 a month. And ideally, way more than that. It obviously depends on what your income is looking like and what your expenses are looking like as to how much you can invest in the stock market. But if you're truly going to commit yourself to this, it is absolutely worth a deep dive into looking at your expenses and seeing if you have an expense problem. I would bet that most people out there can find somewhere between $200 and $400 a month in expenses that are absolutely not necessary that could be going into your stock market accounts. And if that's not you and you already live a pretty frugal life, but you still can't invest $1,000 a month, maybe it's an income problem and you need to think about new ways to increase your income. Maybe get a side hustle, maybe get a second job for a short period of time, maybe get a new credential at your job, maybe switch jobs, whatever it it takes in order to increase your income so that you can put at least $1,000 a month into stock market investing if you want to make this a reality. If you want to be 7 figures plus in your stock market accounts, that is what it's going to take. It's going to take some sacrifice. It's going to take some deep dive into your personal finances. It always starts with your personal finances. Like we said earlier, the amount of money that you have in your stock market accounts is a huge deal as it relates to the compounding effect of money. If you can only put in like $50 or $100 or $150 into your stock market accounts per month, it's going to be very difficult to grow that into a substantial amount of money, even if you're an amazing investor and you get market-beating returns every single year. You really need capital behind you in order to grow in a substantial way. So do a deep dive and be realistic with yourself about the expenses that you have on a monthly basis and see if there's any place you can cut back in order to prioritize investing a little bit more. If your income's not in a spot where you can get $1,000 a month, work on that. But in the meantime, at least be investing 20% of your take-home pay each and every month. Now let's get a little more specific. It's very important to choose an investing strategy that fits the amount of time that you want to commit to this on a weekly basis. If you want to commit less than an hour a week, there's a strategy for that. If you want to commit a couple of hours a week, there's a strategy for that. And then if you want to commit somewhere between 5 and 15 hours a week, there's a strategy for that as well. Now the strategy that takes the least amount of time, less than an hour a week, honestly, is just buying index funds. So buying something like the S&P 500 index fund, something like VOO, or the NASDAQ 100 index fund, the QQQ, or the total stock market index fund, VT, something like that. You can build a very substantial amount of wealth. You will track the market. You'll get respectable returns over time. It's not going to be market beating returns, obviously, because you are tracking the market with the index funds. But realistically, you'll be able to grow your wealth by somewhere between 8 and 10% a year on average over a long period of time. Some years are going to be way, way better than that, up to like 20%, and some years are going to be way worse than that, potentially down on the year. It is possible for stocks to go down on the year. And if you're just index fund investing, your money is going to move exactly with the market. Now, the next level, if you want to spend a couple of hours a week on stock market investing, you can do something called the core satellite strategy or something like the S&P plus 3. The core satellite strategy is pretty simple. You have a core of your index funds, let's say, something that's well diversified, that doesn't take much thought. You could buy the S&P 500 or maybe the NASDAQ, and that's, let's say, 80% of your portfolio roughly is in the index funds. And then the satellite investments are on the outsides. It's the other 20% of your investments. You can buy individual stocks with that other 20% of your money. And that's where you're going to be looking for those growth stock opportunities, where you're going to be looking for those value stock opportunities, maybe those dividend stock opportunities, depending on what your focus is in that moment. If you're looking for income now and you're maybe later in life, dividend stocks might be part of that strategy for you on the satellite part of the core satellite investment. If you want to go the Warren Buffett style, you're looking for value stocks that are trading at lower multiples than the market that you can buy for pennies on the dollar. A very good stock that's trading underneath its fair value in order to reap the benefits and get outsized returns as the market starts to respect that stock again and put it back in its fair value territory. And then if you're a little bit more aggressive investor, you're looking for those growth opportunities, the stocks that can give you a 2x, 3x, 4x, 5x, 10x opportunities. You could be investing in those type of growth companies outside of your core investments in the satellites. You could also do something called the S&P plus 3 that kind of fits into that core satellite strategy. You buy the S&P 500 with the majority of your investment money, and then you pick 3 individual stocks outside of that. Maybe you pick 3 growth stocks, or you try to diversify a little bit. You pick 1 growth stock, you pick 1 value stock, and you pick 1 dividend stock. Something like that so that you can seek to get those outsized returns from stock picking. And then the third investment strategy that absolutely takes the most amount of time but has the most amount of potential for upside is stock picking. This could be for someone who has at least 5 hours per week to commit to stock market investing, to build a portfolio of individual stocks of, let's say, somewhere between 15 and 25 individual stocks that you're holding, that you're managing actively. In order to make this happen, there's a lot of research time that goes into this. Reading 10Qs, reading 10Ks, listening to conference calls, checking out valuation metrics, comparing this company's growth to the overall sector's growth, seeing what the valuation metrics are looking like for this company in relation to their peers. Trying to figure out if the company you're looking into has a stronger moat than their peers and how much pricing power they're going to have as a result, what kind of growth rates they're going to have over the coming years, and whether or not the valuation right now justifies those growth rates in the coming years. It takes a lot of research work and a decent amount of time in order to figure out if an individual stock is a good investment right now for you to put your money in. And that's why I say people who have less than 5 hours a week should not be individual stock picking. They should be sticking to index fund investing or maybe the core satellite strategy where they're only picking a few individual stocks, but not necessarily building an entire portfolio of, like I said, 15 to 25 stocks. If you're going to be stock picking, it depends on your age and your goals, of course. But in my opinion, if you want to really grow your accounts to crazy levels over time, you should put the majority of your money and spend the majority of your research time on growth opportunities. Stocks that you believe can get way outsized returns over, let's say, a 5 to 10 year span. Companies that have a realistic chance of changing your life forever. A stock like Tesla that we have over a 950% gain on. That absolutely changed the trajectory of my stock market portfolio. A stock like Palantir that we're nearing 1,500% gain on. That stock also absolutely changed the trajectory of my stock market accounts forever. Opportunities like that is where the majority of your research time should go and the majority of your investment money should go. But outside of that, I think it's still very important if you want to have a bulletproof portfolio to also hold some value stocks, to also hold some dividend stocks, to also hold some turnaround stocks. A portfolio that's going to fare well in all markets does not just have growth stocks in it. It has other types of stocks as well. The majority, the high majority of my accounts is in growth stocks, in growth opportunities that I see a 2x plus potential with those stocks. But also I have a decent amount of value stocks and they've treated me very well over time. I don't put as much of my money into value stocks. I don't put as much of my money into dividend stocks. I don't put as much into turnaround plays, but I do have all three of those other types of stocks in my portfolio as well in order to make sure that I'm taking advantage of all opportunities in the market. There are some times where dividend stocks are going to do very well for a 2, 3, 4, 5 year span, while growth stocks don't do as well for that same span. There are times where dividend stocks are going to outperform growth stocks. There are times where value stocks are going to outperform growth stocks. Focus on those growth stock opportunities, but don't forget about the value stocks. Don't forget about the dividend stocks, and don't forget about the turnaround plays. You can get very respectable gains and you can outperform in different types of markets if you're diversified to an extent into those 4 different types of stocks. And now the last piece of advice here for building your stock market accounts to crazy levels over time is to leave your emotions at the door. No stock market investing decision should be emotionally driven, okay? Investors who let their emotions drive them are typically those who are buying high when stocks are soaring and then they end up panic selling when stocks drop. And that is the worst possible place to be in. The investors who fare the best over time are those who buy on a fundamental basis. They don't buy because stocks are going up. They don't sell because stocks are going down. They buy because they see a stock that they like at a valuation that they like. And the investors who make the most money over time, not only can they hold through a market crash, but they can buy more through a market crash. A lot of market crashes are fear-based. A stock picker's dream is a fear-based drop when nothing changes about the fundamentals of a company, but the stock drops by 10%, 20%, 30% or more, like we'll see in some of these crashes. You can go out there and buy that stock for a 20, 30, 40% discount and accumulate at a crazy amount of shares at a much lower price and benefit in a major way as the fear starts to subside and greed starts to come back into the market. A stoic investor is a successful investor. A fundamentally focused investor is a successful investor. If you can blend those two things together, you're going to have major success in the market over time. I hope you enjoyed this video and you got some value out of it. And just to keep us long-term focused, in the comments below, let me know your goal for how much money you want in your stock market portfolio in 10 years from now. 1 decade from now, what number do you want to see when you open up your stock market accounts? So put that in the comments below and take the steps in order to make that a reality over the next decade. I appreciate you being here in a major way. Thank you so much. Have a great day.